thank you for taking the time out of your busy schedules to spend this time with us. Just a little bit about me. I've been with the agency a long time, since '89. Been with the Guarantee Program, or in the program, since its inception in 1991. Held a bunch of positions within USDA rural development in the single-family housing programs, mostly in the state of Georgia. But 2020, I moved over to the national office, to the Lender and Partner Activities Branch. And within the LPA, we work directly with lending partners throughout the U.S. to provide support for and training on the single-family housing guaranteed loan program. And we have a few housing programs. We usually like to differentiate between our guaranteed programs and what you might also see either on the web or on our websites. There's a Section 502 direct and Section 504 repair loans and grants. The 502 direct loans are made for purchase existing homes and build new housing. That program is designed for up to 80% of area median income households. And the Section 504 repairs, loans, and grants are targeted at what we call very low and no higher than very low household incomes, which is 50% of area median income. And the guaranteed Section 502 guaranteed loans were added in 1991. And they are targeted for audiences, for the applicants whose household income don't exceed 115% of area median income. So the Housing Act of 1949 is what established USDA rural development to be able to make loans, period. And then in 1991, it was revised to add the guaranteed housing program, single family housing guarantee program. And since these are the only two parameters you can see on the screen there, that we have to be under the household income limits, and the properties have to be in rural areas. So that those two bullet points are written into the law, the Housing Act itself, as passed by Congress. And so these are known as statutory requirements, since they are required by the actual statute or law. And there are no exceptions or waivers available for situations not meeting these requirements, okay, of these two issues. The balance of the program requirements are regulatory requirements and have been determined by USDA rural development to be prudent practices that follow sound business and underwriting practices in administering the program. So just a real high level overview of program eligibility real quickly. The property has to be located in an eligible rural area, and do have, if once we post this PowerPoint onto our training and resource library, you'll be able to download it and click on these clickable links. So it says see maps here. They are clickable links, so that's the purpose of that. So you would be able to see where the eligible rural areas are. And like I said, the total household income has to be within program limits of 115% of median. That also is a clickable link. For some of these links, I do have QR codes. I wasn't able to fit them in on this particular screen here. The applicants who get our loans or the guarantees have to be U.S. citizens, or either non-U.S. citizen nationals or qualified aliens, okay? And the applicant has to have acceptable credit, and USDA no longer specifies any particular credit score. So we recommend that lenders use your lender overlays for that purpose and your own underwriting decisions there. And of course, they have to show repayment ability. And the baseline for repayment ability ratios are 29 and 41. There are exceptions to be made to that with compensating factors, but we won't get into the to the underwriting part of that today. So just kind of briefly mention those. Loan comparisons. So look at this loan comparison chart. And yeah, the interest rates may need to be updated a little bit, but you can see that USDA has the lowest out-of-pocket costs for your applicants, along with the lowest monthly payments of all programs listed here, maybe with the exception of VA, for someone who has their full VA eligibility. And that's only available to veterans, So, and then it only averages out to be about a 40% guarantee versus our USDA's 90% guarantee. Okay. This is what we mean by the USDA loan being one of, if not the most affordable loan products on the market today. So you can see our out-of-pocket costs for our loan and the total PI with MI for the rest of it. It is a small fee for us, a guarantee fee, but bearing those bottom lines there, you can see we're more affordable than any of the other programs there. Okay, today we will cover a combination construction to permanent, also called the single closed construction loan feature, as well as manufactured homes, which are also eligible for construction to perm. And due to time constraints today, we will not be covering the single closed rehab rehabilitation loan feature. We can cover that at a later date if needed. So, combination construction to permanent single closed construction loans are covered in Chapter 12 of our handbook. Anytime you see HB1, that's the handbook 1, part 3555. And so Chapter 12 is right there. And I'll leave it just long enough for you to take a picture of that if you want to. Go ahead and open that on your phone. Okay, and then moving along. So also known as the single closed construction loan, the combination construction of permanent loans, as the name implies, are a combination between the construction loan, which is the short-term interim loan, and the long-term, traditional long-term permanent residential mortgage. Okay. So let's first look at the summary of the construction to perm loan feature. Then we'll look at it a little bit more in detail as we go along. In addition to funding regular new construction projects, we offer a single closed construction program, loan feature, I should say, to help supply affordable housing in rural America. As the name suggests, it's a single loan closing, meaning only one set of loan closing documents is needed. This keeps the applicant from spending money on extra and unnecessary costs. The single close process was designed to protect all participants. Perhaps most importantly, the USDA's loan note guarantee is issued shortly after the loan closing, before a shovel even goes into the ground. Realtors get paid at the closing, and the builder is protected as the build is also funded at closing. This means the funds are there if something catastrophic happens with the borrower, heaven forbid. More on that later, but assuming everything goes as planned, the borrower will find a more comfortable experience as they will have a fixed rate locked for their loan and can escrow, get this, up to 12 months of payments into the loan, build that into the loan itself to avoid having to pay rent plus their new housing payments during the time of construction. And additionally, the loan can include the cost of acquiring land or paying off any balance on the land already owed, already owned. There are also two versions available, the standard interest only version and the securitized version. And we'll take a little bit closer look at those as we go along as well. I can't emphasize enough that USDA's loan note guarantee, not just the conditional commitment, but the guarantee is issued upon the lender's request immediately after loan closing, before the house is built. So I like to kind of emphasize that point. The screen by itself there. Now, issuance of a loan note guarantee. So the actual guarantee is for the full amount of the loan. The maximum payout is 90% of the original loan amount, but the whole amount of the loan is guaranteed. So, and you would make the loan on a 30-year fixed rate loan terms. After closing, funds are dispersed to cover the cost of the land and applicable closing costs. And construction should be completed within 12 months. It says should be. You can extend that if unforeseen circumstances arise. But go ahead and obtain all permits prior to beginning construction. And so there's a formula that equals that we cannot go above the 90% of the original loan amount anytime we pay out a loss, anytime we pay out a claim. So, okay. So let's look at the benefits of doing a combination construction to perm loan. Benefits to the lender. Lenders are protected during the construction by USDA's guarantee. So there's an asterisk there, and the asterisk says that should there be circumstances causing the contract to be broken due to something catastrophic like the death of the borrower or death of the contractor, the lender will ensure that the construction of the dwelling is completed. And if needed, the house would then be marketed, sold, those proceeds applied to the loan balance. And then, if needed, a loss claim would be filed with USDA. Okay. Mentioned the securitized version. That is a benefit simply because the PITI payments are made from reserves. You can build into the loan a reserve account to pay the PITI payments during the construction period. When the securitized version is used, there's no reamortization required. The borrower just picks up making those payments at the end of the construction period. And for the secondary market, the loan may be sold immediately on the secondary market. So you don't have to service that loan even while, if you have a relationship with a lender on the secondary market, you can sell that right away. Banks receive your CRA credits, and you can obviously expand your client base by offering no down payment loan product. Okay. Benefits for builders. As with all USDA guaranteed loans, the builder does not have to put up their own capital or use their line of credit for the construction project. So that's no different for the single close construction. Okay. You can obviously, again, expand the client base by reaching more home buyers with a no down payment loan program. So builders love it. The realtors love it because they get paid before the house is even built. You expand your client base by reaching more home buyers with no down payment loan program as well. And last but not least, benefits to the buyers. So there's only one set of loan closing costs, so that saves time and money. There can be interest reserves or PITI reserves established, which will alleviate the need to make payments on the new loan and pay rent during the construction period. And we mentioned that a while ago, but I think it bears repeating. There are contingency reserves that can be set up so that it protects the borrower against cost overrun payments out of pocket. For a standard interest only, the loan would be reamortized at the end of the construction, and then any leftover reserves would be applied to reduce the principal balance. And of course, owners of new construction have less maintenance concerns than owners of older existing homes. So all benefits to the buyers there. Okay, so we can always loan up to the appraised value on our single family housing guaranteed loan. For the only time there's a caveat to that is if the lender cannot certify and prove that the house meets the agency standards. So if that's the case, then only 90% of the purchase price is able to be loaned. But assuming there's no problems there, we can always loan up to the appraised value. And so you want to be sure to give your appraiser, the cost of the land, all costs associated with the construction, plus any reserve accounts that you plan to build into the loan, so that they can take that into consideration when establishing their opinion of market value. Okay. All right, lender responsibilities. With the combination construction and permanent loan, lenders would oversee the disbursement of the loan proceeds. You would monitor the construction of the subject property, would obtain documentation confirming the construction is complete. Then you would ensure the use of a fixed price construction contract. And, established contingencies are okay. It's not a cost plus type of contract. It would be a fixed price. So that would be the lender's responsibility. So lender requirements. So Once lenders have USDA approval, you do not have to get separate approval to use the single close construction loan feature, okay? By submitting the request for conditional commitment, you are self-certifying that the staff has 2 or more years experience making and administering construction loans. So when you turn in that signed form, you're basically certifying that you meet the qualifications to do that loan feature. In lieu of the above, a lender may employ a construction loan management company with 2 or more years experience doing the same thing. So lenders would confirm the eligibility of the company employed, okay? And the lender would also confirm the eligibility of the contractor and builder themselves. Let's take a look at that on the next slide. Okay, lenders would verify and document in your files the builder has 2 or more years of building construction experience. You see a theme here, 2 or more years experience, right? And that construction experience needs to be specifically in single family housing. It doesn't need to be in commercial building and that type of thing. They would have to have a state issued construction or contractor license if the state they're building in requires that. They would have to have commercial general liability insurance of $500,000 or more. And contractors building their own residence are not eligible for this loan feature, okay? So lenders are required to document your determination for eligibility of the builder to participate in the rural development mortgage transaction as described in the handbook 1, chapter 12. There'll be a link and a QR code for chapter 12 in just a minute. So, okay, let's talk about eligible loan costs, what you can roll into the loan. So from a construction standpoint, what costs may be rolled into the loan? It says the cost of the land, the acquisition, or the payoff of the balance owed. Construction hard costs may be rolled in, costs in the contract and detailed in the budget. Even costs outside of the contract paid to others. In other words, if the builder or if the applicant had contracted with a well and septic installation company separately from the builder, those costs can be rolled into the loan as well. Any roads or driveways to allow for legal egress and ingress, any landscaping required that that would be typical for the area. And then any construction soft costs, inspections and survey fees are eligible to be rolled in. Any contingency reserves, costs for permits or lender administration fees. All of typical loan closing costs can be rolled into the loan so that there's very little, if any, out-of-pocket expense for the applicant borrower, at the time of loan closing. Okay, let's mention the contingency reserve here. So contingency reserve is not required, but it may be utilized to cover eligible expenses associated with unplanned problems with the construction or any change orders, as you go along through the construction process. That contingency reserve is limited. It's capped at a 10% maximum of the cost of construction. That would include the labor costs, the material costs, and the soft costs we just talked about. The funds must be deposited into a contingency reserve account and kept separate from the other funds associated with this project. So the loan closing. So it says here that the standard industry closing documents are used. So USDA does not require our own closing documents. You use what you're used to using. The lender ensures that the promissory note was signed and that you have a valid first lien at the closing. That is a requirement. The term of the loan closing is 30 years. We mentioned that earlier. The interest rate during construction must be a fixed rate. Okay, I'm going to say that again. The interest rate during construction must be a fixed rate. Look at the next bullet there. It says adjustable rates during construction are not allowed, but the rate during construction may be higher than the permanent rate. And our reg reads that the permanent rate may be reduced at reamortization. So that's the kind of the backwards way of saying what the reg says there. All right, so the annual guarantee fee begins to accrue at the loan closing and will be due each year at the anniversary date. Okay. Payments during construction. Here's where we start to differentiate between the standard interest-only loan feature and the securitized feature. And there'll be at least one more screen about this. So the tried and true way of doing construction is the interest-only. The payments of the accrued interest, that accrues on the draws that you pulled down. The payments on those are made during the construction period periodically. Or you can go the securitized route, whereas the full PITI payments are made during the construction. And so we'll look at that in just a second. So the reserves may be established from loan funds to cover payments due during construction for either option above. Where there's the interest only, you can do a reserve for interest, or you could do a reserve for the full PITI payments. And both of those reserves are limited to 12 months, no more than 12 months of payments. Okay, so you could build that into your loan. You could estimate those costs and build that into your loan. Okay, so first of all, we're going to take a look at the interest-only option. So again, you could make those payments from the established reserve account, or the borrower could make those payments directly. And of course, you would have to document their ability to make those payments, document their own reserves. Okay, this is the screen that kind of compares and contrasts the two. So for both options, the interest rate, the construction contingency, and the payment reserves are established at loan closing. The loan note guarantee is issued at signing and construction begins. The securitized version. So the principal, interest, taxes, and insurance payments are made during construction from the established reserve. And then once construction is complete, no loan modification is needed. The excess contingency reserve funds are applied as a principal curtailment. Okay, so let's contrast that to the interest-only version. So if you choose this option, the monthly interest is paid from the interest payment reserve on the construction loan balance, or from the borrower's reserves, as we mentioned on the screen before. Then once the construction is completed and any excess reserves are applied to the principal, then the loan can be modified and reamortized within the remaining balance, or reamortize the remaining balance within the remaining term of the loan. Okay, and I realize that says within the remaining term of the loan. There's a screen about that in just a second. So warehouse lines of credit may be used, and you can use a dual disclosure showing the terms of the interim and the terms of the permanent, if you are used to doing that, or you can use a single disclosure that blends the terms of the two. Okay, we don't dictate which one you have to use. So this is the screen on the interest only, and it mentions it in the header that a reamortization would be needed after the loan construction is complete. So when it is complete, the reamortization may be utilized to achieve full repayment for the remaining term of the loan. So if it was a 360-month term, it took 12 months to build that house, then you're going to reamortize it for 360 minus 12. That'd be 348 months. And so the term when you reamortize it would be the original term less the construction period. Okay, so the second bullet there says, however, that if the loan modification causes a higher PITI payment than those used to underwrite the loan, USDA does not require re-underwrite. Okay, because the loan's already closed, our loan note guarantee is already issued, the horse is out of the barn, so to speak. So that's kind of where we come from on that. The interest rate for the permanent loan may be lowered with the modification, as we mentioned earlier. The lender to provide the executed modification agreement to USDA. Amortization must begin no later than the first of the month, 60 days from final inspection. Okay. 60 days from the final inspection. So, and then of course, as we've been saying all along, excess funds from the contingency reserve will be applied as a principal reduction. Okay. So the securitized version, after loan closing, the PITI payments are made during the construction, as we've mentioned. You may lend up to 12 months of payments during the construction period. The lender, the lender, manages those payments. There's no need for a loan modification or reamortization because the borrower just resumes the payments at the end of the construction period. They just pick up the payments where the reserves left off. And any excess funds will be applied as a principal curtailment. The construction draws, the lender requirements would be the draws and disbursements are managed and recorded by the lender or the lender's construction management company, whichever one you use. The borrower and lender are jointly responsible for making those draws. So you would need, both signatures on those draws, each one. You would need to retain the documentation to confirm the work has been completed for the draws dispersed. And when you look in the box there, it says when the funds are dispersed, the lender is warranting to rural development that the work was done as specified. So we don't ask you specifically for that. It's kind of built into the process. Okay. Change orders and unplanned changes. In the box there, it says unplanned changes during construction. Should a life change occur with the borrower, such as a loss of job or death, the lender remains responsible to work with the builder to complete the home. Then any typical change orders must be approved by the lender. So it doesn't need to just be a sidebar issue between the applicant and the builder. Borrower is responsible for any costs related to a change order that will exceed available loan funds. Okay, they need to know that up front. And then proposed changes should not affect the scope of the project or the appraised value. I remember one case we had where the builder and the applicant had a sidebar, and they decided not to make it a brick house but a vinyl house, and not to have it a hip roof but a gable roof. And the house really didn't look a lot like anything like it started out. The appraiser would have to decide whether or not those changes have any effect to the market value. And then we're moving to the construction closeout. Once construction is complete, the lender obtains and retains in their file the appraiser's final inspection, the certificate of occupancy, the final title policy clear of all liens, the construction phase inspections, construction contract, the cost breakdown of the contract, construction ledger, that would be of the draws made, and then the builder's warranty. The lender also completes the closing in the lender loan closing system, and we'll get to that in just a minute. Let's look at the builder's warranty first, though. So the handbook has been updated in recent years, and so now in Chapter 12, so you see the link. It is a clickable link once you have this on your desktop, but we also have a QR code there. Let's take a minute to look at the documentation requirements for new construction for stick-built homes. I'll have one for manufactured homes in just a minute. But evidence of the certified plans and specs, option 1. So each one of these has 3 options. So evidence of certified plans and specs, option 1 says that a copy of the certification from a qualified individual or organization that the reviewed documents comply with the applicable development standards, all the codes that new construction has to meet. Or option 2, certificate of occupancy issued by a local jurisdiction. Or option 3, a building permit or its equivalent issued by a local jurisdiction. Okay, that's evidence of the certified plans and specifications. All right, second column says evidence of construction inspections. Option 1 would be a CO issued by a local jurisdiction showing that it has performed at least 3 construction phase inspections as identified in Chapter 12 of the handbook, and an acceptable 1-year builder's warranty. Okay, as a minimum, all new construction will have a 1-year builder's warranty. So you can get the CO from the local jurisdiction that's performed the inspections, at least 3, and a 1-year builder's warranty. Option 2 is the 3 construction phase inspections performed at each phase identified in section 12.9B of the handbook, and an acceptable 1-year builder's warranty. Okay. Or option 3 would be a final inspection, in parentheses only a final inspection would be required when you get a 10-year insured builder warranty. And the note there says builder back 210 warranty fulfills the 10-year warranty requirement. So you only have to have a final inspection if you have that 10-year warranty. Okay, so the third column talks about evidence of thermal standards. I don't know if any of y'all have been using the program long enough to remember that USDA used to actually specify the R values in the attic, in the walls, under the floor of a crawl space, that type of thing. We no longer do that. It just you all certify or have the builder certify that the plans meet the energy codes by one of these 3 options here. So it says a qualified registered architect or qualified registered engineer may certify the confirmation with the IECC standards. That's the International Energy Conservation Code. So it would be, I said earlier, it would be a builder, but this would actually be a architect or engineer that would be certifying to that. Or you could go with a builder, can certify the compliance with the IECC standards. Or option 3 would be the final inspection or certificate of occupancy issued by a local jurisdiction. So you have some options there. So options are good, right? Okay, let's look at the same type of requirements, but we're moving over to manufactured homes. And I know we haven't talked a lot about manufactured homes yet, but while we were talking about these requirements, I thought we'd kind of lump them together, and in just a few screens, we'll jump over and talk about manufactured homes. The evidence of the certified plans and specifications, that first column to the left, is exactly the same as the one we just read. And I failed to mention on the other screen that the form RD 1924-25 plan certification is an acceptable format in order to certify from that qualified individual for the plans and specs. So all that's the same as the screen we just left. The second and third columns there are different. So let's take a look at them. Evidence of construction inspections for new construction manufactured homes. Certificate of occupancy issued by a local jurisdiction showing that it has performed at least the footing and final inspections as identified in Handbook Chapter 12.9, Paragraph 0.9B, and an acceptable 1-year builder's warranty. There's that 1-year builder's warranty again. Or option 2, the footing and final inspections performed by a qualified inspector as identified in, again, Handbook Chapter 12, and an acceptable 1-year builder's warranty. Okay, so you can either have the CO or the actual inspections themselves along with the 1-year builder's warranty. Option 3, be a final inspection, and you could again put only in parentheses right there, and a 10-year warranty, insured warranty, and a 10-year insured builder's warranty. Again, the builder back 210 warranty fulfills the 10-year warranty requirement. So again, spelled out pretty well right there what's needed on the construction inspections. And again, evidence of the thermal standards. Again, we still do require that the properties we place guarantees on do meet the thermal standards. So option 1 would be a HUD data plate, would confirm with confirmation that the IECC standards are met. Okay. Or the builder may certify confirmation with the IECC standards. And option 3 would be the final inspection or the CO issued by a local jurisdiction. So we're making some assumptions there that the local jurisdiction would not issue the CO without knowing that the property being placed would meet the IECC. And that QR code there is for Chapter 12 specifically out of our handbook. Okay, so going back to the certified plans and specifications, acceptable evidence of plans and specs include any one of the following. We mentioned the certification from a qualified individual or organization and the Form RD 1924-25 plan certification is acceptable for this purpose. And I guess the main reason for this screen, I included it, was to just kind of show you a little bit of what that plan certification looks like. That we provide as an option there. But again, the second, third bullets just say that the certificate of an CO from a local jurisdiction could be one option in certifying those plans and specs. And same thing with the building permit from a local jurisdiction. Okay, one thing you always have to remember is that about rural development loans, you can't really issue cash back to the borrower unless they have already directly put money into the transaction, and that's a reimbursement of those funds. And so lenders must apply any excess loan funds as a principal reduction unless it's reimbursement of funds for costs paid directly by the borrower. Those are permitted. Funds remaining in the contingency reserve account may be used for an eligible loan purpose. Yeah, they could be used for an eligible loan purpose or applied as a principal reduction. So get down to the nitty gritty. If it's something that they need to be or want to have done, and it would have been an eligible loan purpose from the start, then yes, they can actually use those funds for that. No cash back to the borrower. Otherwise, it's not a cash out program. Okay. All right. We mentioned manufactured homes. They are covered in special property types in Chapter 13. The whole chapter does not cover manufactured homes, but manufactured homes are found within Chapter 13. So, and there's a QR code there if you want to take a look at that link and send it to your email. We were talking about that the other day. I know QR codes are not much good if you were on the computer, but if you take if you take a snapshot of that QR code on your phone, and then you can send that link maybe to your desktop or to your inbox, email inbox. So I've kind of repeated that, so maybe you can go ahead and get a screenshot of it or snapshot of it. All right, so expanding affordable home ownership. The single closed construction loan feature pairs really well with manufactured homes. USDA will guarantee loans on manufactured homes that meet the standards on the following slides. Okay, so for new construction, the units must have a site that conforms to state and local standards, be a new unit in stock that has never been installed or occupied at any other site or location. Okay, now again, we're talking about single closed construction. We are able to finance existing manufactured homes, but we're speaking specifically to the single closed construction loan on new homes. Have a floor area of not less than 400 square feet. Okay, that says a lot right there. When we're asked about tiny homes, we say, yeah, we can do tiny homes as long as it's not a manufactured home, because that has to be, manufactured homes have to be larger than 400 square feet. The unit must be placed on a permanent foundation per the HUD guidebook 4930.G3. And I was not able to put a QR code for that. Couldn't fit it in there. But again, this is a clickable link once you get it on your desktop. And we'll show you where that, or mention where these will be stored in the next, maybe in the next week or so. But you would meet or the property has to meet or exceed the federal manufactured housing construction safety standards for the geographic area that the unit will be placed in. So if it was built in another state, it's got to meet the requirements, including the thermal standards of the state where it was going, where it will be permanently placed. Okay. The agency will not guarantee the purchase of a unit without an eligible site. Repairs associated with a unit not already financed by USDA. Furniture or any other movable articles of personal property, if that's wall-to-wall carpeting, refrigerators, ovens, washing machines, etc., are allowed, it says. So So that's kind of the exception to the personal property, what could be considered personal property. I believe our handbook specifies those items right there as well. And additions or modifications other than structures built to engineered designs will not be guaranteed by USDA. Okay, the agency will also not guarantee the purchase of a unit moved from one site to other than the dealer's sales lot. Again, this is for new construction. Units older than 12 months from the date of the loan closing using the construction of perm single close construction feature. And to be clear, units that do not meet the definition of any of new may still be financed if they meet the guidelines for existing manufactured homes outlined in Chapter 13 of the handbook. So I should have just saved all that for that one-liner right there. A unit with a tow hitch or running gear remaining will also not be eligible for guarantee. Okay, so the lender's permanent file must contain an itemized cost breakdown of the total package, the dealer certification that no cash back will be paid directly to the applicant, the dealer certification that proposed cost is the full price of the unit, so there's no kickbacks. Okay. The foundation plan that meets HUD handbook, again, HUD handbook 4960.3G guidelines, which is the permanent foundations guide for manufactured housing. Your permanent files must contain the plot and site development plans, and that can be a lot that goes into a site development plan. There's a lot of information that really needs to be on there. Inspections required by the handbook, Chapter 12, would also be saved in your files. And the contractor certification that the units were properly joined and sealed and sustained no damage during transportation and setup. Okay, and then additional loan closing requirements would be the warranty. The dealer must provide the borrower with a copy of all manufacturer warranties. You know, that's whether that's on the stove, the heating and air, the unit itself, that type of thing. Lien releases. The dealer must furnish a manufacturer's certificate of origin indicating that the unit is free and clear of all legal encumbrances. Real estate tax. Unit and site must be classified, zoned, and taxed as real estate. So you cannot do any chattel loans with this program. Title and lien, both the unit and the site must be evidenced by a recorded mortgage or deed of trust. Okay. All right, so basically that's it as far as an overview of the single close construction for both site built and manufactured homes. So let's take a second to look at our GUS screens. For those that are new to the program or maybe wondering, GUS stands for the Guaranteed Underwriting System. It's our automated underwriting system specific to USDA rule development. And before we get into any of the details about it, we need to remind you that lender employees who utilize GUS, each employee is required to have their own individual login. So do not share logins between employees. I know it's tempting, but you can't do that. So we have to make clear that repeated abuse of the system in this way could jeopardize the lender's approval to use GUS and even jeopardize the approval for USDA Single Family Housing Guaranteed Loan Program, period. So there are ways to get each employee their own login. Okay. For new construction, when inputting initial information into GUS on the lender loan information screen, which is in the transaction detail field, please make sure to pay close attention to the fields shown above and on the next couple of screens to correctly code the loan as construction to perm. Without proper coding, this information is not accurately captured. Therefore, I want to point out a couple of things on this screen. Number one, notice in the middle of the screen that once the construction, conversion, or construction of permanent is chosen, then you still have to choose the single closing right there as well. And the year built would actually need to be input as well. Okay, the year that the construction was completed. And here on the loan and property information screen, the loan purpose buttons for purchase should be chosen. So even though it's a new construction, you still have to code it as purchase right here. It's obviously not a refinance. And even if you are paying off the balance of a loan on the lot only, you'd still code it as purchase right here, not a refinance. Okay. Here on the additional data screen, the purchase drop-down menu, you would choose new and also answer the questions appropriately there. Okay. Now, so we wanted to make sure that you were inputting the information correctly to code these as single close construction or construction to perm. Now let's point you in the right direction for closing out the loan in the lender loan closing system. So we're not going to go into a lot of detail. This is just kind of an overview of how to get loans closed out. So we do have a single close / rehab user guide that's available at this website. And yes, you can, this isn't a live link. So always refer to this user guide provided in our link training and resource library under the loan closing tab for details on how to close out this type of loan. And a QR code is provided here for your convenience. So the next screen will have a different QR code on it. So if you need to take a picture of this QR code, go ahead and do that before I change screens. Okay. Now, so in the guide, it will refer you to the USDA link site, a whole different website. And this is a different QR code than the last one we just provided. Note that there are no differences when requesting a loan-up guarantee on the add loan closing screen between a single close construction and a normal purchase loan. Okay, so there's no differences up to that point. The difference is when you have completed the construction phase of the single close. Okay, we'll take a look at that in just a second. So if you go in, please be aware that if you go into the LLC lender loan closing system, you will be presented with this type of screen if you have access to more than one lender in the lender loan closing. So choose your appropriate lender ID there. Our single close construction loans do require an important step for closers and post closers to complete once the construction is finished. On the lender administration list tab, I don't know if you can see that it's pretty small right there, but that's the tab we're talking about right there, the lender administration list. The lender type should be, the lender type must equal originating right there in the middle of the page. And the request type would be loans, okay, the one right next below it, with the action field as single close / rehab, okay? So single close and rehab, since they're both single close type loans, the construction and the rehab are lumped together there. Okay, pretty straightforward there if you just know what to look for. The borrower information will then pop up. It will populate on this particular screen. Note that the three choices of construction type at the bottom of the page, it will allow for additional data entry when you choose that as well. So let's take a look at those real quick. Principal reduction only. Enter the construction completion and principal reduction fields. Update the modified unpaid principal balance and the amount of the principal reduction. Upload documentation of evidence of the principal reduction and the lender certification that all has been closed out. Okay, and finally, the lender will upload, well, that's the last bullet there, upload the supporting documentation for evidence the principal reduction and the lender certification have been done. Okay, so that was for the first option. The second option here says principal reduction with loan modification. So for those loans with remaining funds after construction with the loan modification, you will want to select the principal reduction with modification for your completion type. With this option, you must complete the following fields: construction completion date, modified unpaid principal balance, principal reduction date, principal reduction amount, a loan modification date, lower interest rate when applicable, and the lender will also upload the supporting documentation for evidence, the principal reduction, loan modification, and the lender certification, just like the first option there. Okay. Hoping that pretty straightforward and making sense. And then finally, that third option there, construction rehab complete with no principal reduction or loan modification. So when this is the case, then you will select construction complete, no principal reduction or modification for your completion type. With this option, you only need to enter the construction completion date and then upload the lender certification. All right. Pretty straightforward. Sounds like a recipe for success, doesn't it? So that's pretty much it for the meat of the presentation. Let's take a look at the resources that we have to offer. So our website, which is the general website, is the www.rd.usda.gov, and you'll come to this page and you'll hover over programs and services and then choose single family housing programs right here. Then it will take you to this page that you could choose between either the direct loan program or the guaranteed loan program. If you go that route, you obviously will choose the guaranteed loan program. And we've also included the handy dandy QR code there for this particular site. Okay, so that's handy for that. So, and we do just talk about the handbook here. Anytime you're looking at the guaranteed program, if you run across, remember early on I said that we have a direct loan program as well, where the agency makes the loan directly to the low-income households and individuals. Well, its handbook number is very similar to the guaranteed handbook number. Its handbook number is 3550. So anytime you see that, you want to always make sure that you're reading out of the 3555 guaranteed handbook. Okay, and all of the property and appraisal requirements today that we talked about, as far as the single close construction loans, it's all located in Chapter 12, as we mentioned earlier. And this just kind of gives you an idea of how the handbook is laid out. It's in pretty logical order. But there are 20 chapters, 1 through 20 there. There's a section on acronym and a glossary. And I usually like to point out the fact that the 7 CFR, that's the Code of Federal Regulation, Part 3555, as written by the agency and approved by, let's see, Congress actually had to approve that, didn't they, since it was part of the code. It's actually Appendix 1. So the handbook expands on everything that's covered in the actual Code of Federal Regulation there. And you can see the other appendices there. Okay. We mentioned, let me go back here. Go ahead and bookmark this page when you get there. Resources, directives, handbooks, because you want to revisit and keep the handbook handy at all times. It's not a great idea to download the handbook onto your desktop because it's updated periodically, and you'll always want to visit the live handbook version that's on the USDA website here. And one quick tip is that you can always use Control F that would be to enable the find feature. So if you're looking for any term, you can do Control Find, and when you have the chapter open, it will find every instance that your term is mentioned in that particular chapter. It's a pretty cool and handy tool to have. Okay, our USDA link training and resource library is always available at this particular link, and I do believe we'll have a QR code in just a second coming up. On this particular site, you can always look at our loan status, and we will tell you what date we are working on loan submissions, to know, gosh, if you turn one in a week ago and we're working on loans from yesterday, and you haven't heard from us, you need to follow up on that particular loan. So that information is stored here. New information, there is a new information section there. What I really want to point out is the on-demand training modules. Y'all, there are a lot of good information stored in these tabs here, from loan origination, lender trainings, These are 10 to 15-minute modules on specific topics that if you wanted to brush up on a particular topic or have new employees that want to go through this is training on demand. And at any point in time, we do ask you to go, have employees go through these particular trainings first. But if you want a training for your group, we can always, our lender and partner activities branch can always provide group training on our programs based on the topic that you choose. The loan closing, I mentioned that earlier. That's where the link and the user guide lives. That's where it's stored, and it's a lot of good information there. View contact information. So when you if you click on view contact information, you'll see this, and you'll notice that we've moved from 4 teams down to 2 teams since this time last year, as far as processing your loan requests goes. So once you turn a file into us for review, and if you have questions about that particular file, you'll see, based on the state in which the property is located, which team to contact if you need to pull that file back or resubmit or whatever there, or just have a discussion with us about it. You'll see, use those email addresses provided there. Our program training and marketing outreach, that's the lender and partner activities branch that I serve on. One of the most, probably one of the most used resources is our loan scenario help desk, loan policy and regulation help desk. They have an email address you can see there, or you can contact them directly through a toll-free number, and I'll have that toll-free number on a page right by itself coming up here. Let's go ahead and look at that. Oh, the GUS help desk is available there. The e-authentication help desk is available there. Anytime you have to file a lost claim, you see our servicing email address there. So really good resource to have this. And at the bottom of this page, it's now more vertical than it is wide. So on the next page, it's a continuation of this sheet here. It just talks about, again, that's the last thing you saw on the screen before, but the monthly and quarterly status reporting. These are links when you're actually on this page. These are links to the regulation in the handbooks, the USDA link that we talked about, the training and resource library, and any Gov deliveries. If you like updates on our program sent to your email inbox, you can certainly sign up for those, and they'll come in without you having to ask for them. So, but yes, there's a QR code specifically for this, for our link training and resource library there. Okay, let's see. Oh yeah, the toll-free number, and you can obtain turn times by dialing that and hitting option 1. If you have specific file questions, once you turn your file in to us, you would hit option 2 to speak to our loan processing division. Lender recertifications and approvals. By the way, every lender who is certified to use our program has to recertify every 2 years. So please pay attention to those when you see them come into your emails. Okay, it's not a hard process. It is a process that has to be done though every 2 years. That's option 3. And then again, the policy and scenario questions would go to option 4. So if you have a situation where you're not quite sure if the applicant would be eligible or a property would be eligible, go ahead and pick up the phone, dial this number, and hit 4 and be able to talk to us right then and there. Our GUS technical questions would be routed to another number here. You would hit option 2 and option 2 after dialing that number. Right, so some pretty good hands-on stuff right there. So, all right, with that, that pretty much concludes it for us for today. And I don't believe we were going to go back to Julie for any reason to close us out. So, well, y'all, I appreciate you all spending your time with us, and we'll see you on another training very shortly. So thank you again for everyone who joined us today. Thank you and take care.